Stop what you are doing and pay attention because the silver market just did something on Friday that rewrites the entire playbook for this metal going forward. Silver ripped 7.8% in a single session. One session. It closed at $85 an ounce after spending weeks getting beaten down from a high near $121 in January. Most people saw that move and thought it was a dead cat bounce, a relief rally, normal volatility in a choppy market. They are wrong. They are dangerously, catastrophically wrong, because that 8% move was not random. It was not technical. It was not some algorithm glitching out on a quiet Friday afternoon. That move was the first visible tremor of a structural shift that connects Nvidia's next generation of artificial intelligence hardware to the physical silver market in a way that almost no one in mainstream finance is talking about. And by the time they start talking about it, the move will already be over and you will be standing on the platform watching the train pull away. Before I go further, nothing in this video is financial advice. I am not a licensed advisor. I am not telling you to buy, sell, or hold anything. I am presenting publicly available data, market mechanics, and my own analysis. You are an adult. You make your own decisions. You bear your own risk. Talk to a professional if you need guidance. I am just the guy who refuses to let you sleepwalk through the most important commodity story of the decade. If you are new here, my name is Mr. AG Asian Guy, and this channel exists for one reason: to cut through the noise, ignore the narratives that comfortable people want you to believe, and show you what is actually happening in the silver market using data, mechanics, and history. If that sounds like something you need in your life, subscribe right now and turn on the notification bell, because what happens between now and February 28th could determine whether you are positioned for generational wealth or left holding the same devaluing paper everyone else is clutching. And before we get into the substance, I want to hear from you. Drop a comment right now. Tell me where in the world you are watching this from. Are you in the United States, the Philippines, India, Canada, Australia, Japan? I want to know because what I am about to explain affects every single country differently. And I want to understand who is in this community. Also tell me, did you buy the dip when silver fell from 121 to 84? Or did you watch from the sidelines? No judgment either way. I just want to know where your head is at. Now let me explain what actually happened on Friday and why it matters more than any single day move in silver that I can remember. Silver did not just bounce, it broke a downtrend. If you pull up the 2-hour chart, you can see it clearly. From late January, when silver peaked near $121, a descending trend line has capped every rally attempt. Evie. Every time silver tried to push higher, sellers stepped in at that trend line and knocked it back down. It happened at 110, it happened at 102, it happened at 95. Each rejection was lower than the last. A textbook downtrend. Bears were in control. The narrative was simple. Silver got ahead of itself. The rally was overdone. Time to consolidate. Maybe retest 75, maybe lower. And then Friday happened. Silver sliced through that trend line like it did not exist, not on low volume, not on a thin holiday market. It blew through with conviction and closed at $85, above both the 50-day exponential moving average at $79.20 and the 200-day exponential moving average at $82. In technical analysis, that is called a golden cross recapture. It is one of the most reliable bullish signals that exist. It does not guarantee anything. Nothing in markets is guaranteed. But when a commodity breaks a multi-week downtrend, recaptures both major moving averages, and does it on a nearly 8% single session move, you do not dismiss it. You pay very close attention. But here is what separates this move from a normal technical breakout. This move has a fundamental catalyst behind it that most silver analysts are completely ignoring because they are still thinking about silver the old way. They are thinking about silver as a precious metal, as gold's little brother, as a monetary hedge, as a shiny object that preppers hoard. And while all of those things are true, they are missing the story that is actually driving the price. Silver is no longer just a precious metal. It is a critical technology metal. And the entity that just made it critical is Nvidia. Let me explain this carefully because it is the most important thing you will hear about silver this year. Nvidia is rolling out a new generation of data centers built on 800-volt high voltage direct current architecture. If that sounds like jargon, let me simplify it. Traditional data centers run on lower voltage systems, NV. NVIDIA's next generation AI chips, the ones powering every major artificial intelligence application on Earth, produce so much heat and consume so much power that traditional architectures cannot handle them efficiently. The solution is 800-volt systems. Higher voltage, more power density, more heat, and a critical need for materials that can manage thermal loads and conduct electricity with minimal loss. And this is where silver enters the picture. Silver is the single most thermally conductive and electrically conductive metal on the periodic table. Not one of the most. The most. Nothing conducts electricity better. Nothing manages heat transfer more efficiently. At 800 volts, the advantages silver has over copper are not marginal. They are decisive. Copper oxidizes. Silver resists oxidation. Copper loses more energy to resistance at high voltages. Silver loses less. In systems where efficiency differences of 1 or 2% translate into millions of dollars in energy costs, and the difference between a functioning AI chip and a fried one, silver is not a luxury. It is a necessity. Now think about the scale. Every major technology company on Earth is building data centers right now. Microsoft, Google, Amazon, Meta, Oracle, and dozens of others. They are spending hundreds of billions of dollars collectively, and every single one of those data centers needs Nvidia chips. And every Nvidia chip installation in an 800-volt architecture needs silver. Not might need silver, needs silver. The demand is price inelastic. That means it does not decrease when the price goes up. If silver goes from 85 to 120, Nvidia does not redesign its chips to use copper. Microsoft does not cancel its data center build-out. The silver cost per server is a tiny fraction of the total system cost. They absorb it, they move on, they keep buying. But it gets even more interesting. And this is the part that I have not seen anyone else explain properly. These same technology companies are building their own solar farms to power their data centers because the electrical grid cannot supply enough power fast enough, so they are constructing massive solar installations next to their data centers. And what do solar panels require? Silver. Silver paste is the conductive layer in every solar cell. The newer panel technologies, TOPCon and heterojunction cells, use 50 to 80% more silver per panel than the older technology. So you have a double loop. AI companies need silver for the chips inside the data center and silver for the solar panels that power the data center. One demand driver creates another demand driver. It is self-reinforcing. And neither demand driver is optional. You cannot run the AI chip without the silver thermal solution. You cannot power the data center without the solar farm. You cannot build the solar farm without silver paste. It is a closed loop of escalating demand with no substitution available at any point in the chain. Now I want you to hold that demand picture in your mind while I show you the supply side, because this is where the math becomes terrifying for anyone who is short silver. Global silver mine production is stuck at approximately 800 million ounces per year. It has not meaningfully grown in a decade. Silver mining is unique among metals because approximately 70% of all silver mined in the world comes as a byproduct of mining other metals: copper, zinc, lead, gold. When companies mine those metals, silver comes out of the ground with them. It is not the primary target, it is a bonus. That means you cannot simply increase silver mining by opening more silver mines. Most silver comes from mines that are primarily digging for something else. And the economics of those other metals determine how much silver gets produced, not the price of silver itself. The dedicated silver mines that do exist are getting more expensive to operate. Fee. Arst Majestic Silver, one of the largest primary silver miners on Earth, just reported that their all-in sustaining costs for 2026 are expected to reach $26.15 to $27.91 per ounce. That is a 25% increase from the prior year. Mining costs are rising because the easy deposits have been found. The remaining ore bodies are deeper, lower grade, harder to access, and more expensive to process. Fuel costs are up, labor costs are up, regulatory costs are up, environmental compliance costs are up. Every input that goes into producing an ounce of silver is more expensive than it was a year ago. And here is what that means for price. If it costs $27 to produce an ounce of silver and the price drops to $70, the margin is still positive. Mines stay open. But if the price drops to 50 or 40, suddenly miners are operating at thin margins or losing money. They start curtailing production. They defer maintenance. They close marginal operations. Supply drops. And reduced supply in a market that is already in deficit makes the deficit worse, which makes the price go back up. Mining costs have created a structural price floor under silver. The floor is not at $27. The floor is wherever the marginal mine stops being profitable, plus the premium the market requires to incentivize continued production. Realistically, that floor is somewhere between $65 and $75 in the current cost environment. Silver is not going back to $30. It is not going back to $50. The cost structure of the mining industry will not allow it. And here is the number that ties it all together. 2026 will be the 6th consecutive year of structural supply deficit in silver, 6 years in a row where demand has exceeded supply. The expected deficit this year is approximately 67 million ounces. That is 67 million ounces that must come from somewhere other than new mining. It comes from above-ground stockpiles, inventories, recycling, metal that already exists being drawn down year after year. Those stockpiles are finite. They do not regenerate. Every year the deficit continues, the remaining buffer shrinks. And when the buffer runs out, the price does not rise gradually. It reprices violently because there is nothing left to fill the gap between supply and demand except price rationing. Now let me tell you about the deadline that almost nobody is watching. February 28th, 5 days from now. The Shanghai Futures Exchange, the SHFE, has mandated that all non-hedged speculative positions in silver must be closed or converted by February 28th. This is not a suggestion. It is a rule. If you are a speculative trader on the SHFE with an open silver position that is not backed by a physical hedging need, you must liquidate or roll that position by the 28th. Think about what that means. The SHFE has already raised margin requirements for silver to 22%. 22%. That is enormous. That alone pushed out smaller speculators who could not afford the increased margin. But the February 28th mandate goes further. It forces even the larger speculators to act. And forced action means forced trading. Forced trading means volatility. If net speculative positioning is long, meaning more speculators are betting on higher prices than lower, the forced liquidation could temporarily push prices down as those longs are unwound. That could create a short-term dip, a washout, a shakeout designed by the exchange mechanics themselves. But here is the other side. If those speculative positions are cleared out by February 28th, what is left? Only hedged positions, only institutional money, only the players who have real physical exposure and need futures contracts to manage their risk. And that market, a market purged of speculative froth, is actually more likely to reflect true physical supply and demand dynamics. In other words, the SHFE is cleaning the table, removing the noise traders. And once the noise is gone, the signal becomes clear. And the signal, as we have established, is a market in its 6th year of deficit with demand accelerating from AI, solar, EVs, and electronics. So February 28th could create a paradox. Short-term volatility and possible downside in the days leading up to the deadline, but a cleaner, stronger, more physically driven price discovery mechanism afterward. The dip before the deadline could be the last great buying opportunity before the institutional-driven repricing begins in March. Let me give you the technical levels you need to watch because understanding the chart right now is critical. $82 is the line in the sand. It was resistance. Silver broke above it on Friday. It is now support. If silver holds above 82 through early this week, the breakout is confirmed. The bears failed. The downtrend is over. If silver falls back below 82 and stays there, the breakout was a fake out and we are likely headed back to test 75 to 79. 86.34 is the first real resistance above. This is the level where the February correction stalled multiple times. If silver can close above 86.34 on a 4-hour candle, the path opens to 92.31, which is the next major Fibonacci extension level. And above 92.31, you are looking at a retest of the psychological $100 level. I want to be clear about what a move above 92 means. It means the market has decided that the January high near 121 was not a blow-off top. It was the first wave of a larger move, and the correction from 121 to 84 was just that, a correction, a pullback within a larger bull trend. If silver clears 92, the target is not 100. The target is 121 again, and then higher, 130, 150. Potentially triple digits turning into quadruple digit conversations if the supply deficit persists and AI demand accelerates on the timeline that Nvidia's roadmap suggests. Now I know some of you are sitting there thinking this sounds too good to be true. Silver always disappoints. It rallies, it crashes, it goes nowhere for years. I have heard this story before, and I understand that skepticism. Silver has broken a lot of hearts over the years. The 2011 high, the 2021 squeeze attempt, the endless cycle of hype and disappointment. I get it. But I need you to understand that this time, the fundamental setup is genuinely different. Not because I am biased, not because I want it to be different, but because the demand drivers are different. In 2011, the silver rally was driven almost entirely by investment demand and short squeeze mechanics. There was no structural industrial demand shift, no AI revolution, no 800-volt data centers, no solar build-out at this scale, no EV revolution at this pace. The demand was speculative, and speculative demand is elastic. When the price got too high, speculators sold and the rally collapsed. In 2026, the demand is industrial. It is inelastic. Nvidia is not going to stop building data centers because silver costs 85 instead of 60. China is not going to stop installing solar panels. The world is not going to stop making electric vehicles. Medical devices still need silver. Defense systems still need silver. Every smartphone, every server, every circuit board still needs silver. This demand does not go away when the price rises. It absorbs the price and keeps buying. And the supply response is non-existent on any meaningful timeline. You cannot open a new mine in 6 months. You cannot accelerate byproduct recovery from copper mines by decree. The supply is what it is for the next 5 to 7 years minimum. So you have accelerating inelastic demand meeting fixed supply with a shrinking inventory buffer. The math is not complicated. It is just uncomfortable for people who need the current system to keep functioning as designed. Quick question for the comments. I want to know what you think. Is this AI demand story real or is it overhyped? And at what price do you think silver becomes too expensive for industrial users to keep buying? Drop your number below. I am genuinely curious because I think most people dramatically underestimate how high that number is. When silver represents less than 1% of the cost of a $50,000 server rack or a $500,000 solar installation, the price can double or triple before any industrial buyer even blinks. Let me also address what First Majestic's earnings tell us about the broader mining sector because this is underappreciated. First Majestic beat earnings estimates but guided for higher costs. On the surface, that sounds bad for the company. Higher costs squeeze margins. But zoom out and think about what it means for price. If First Majestic, one of the most efficient primary silver miners in the world, is seeing costs rise 25% year over year, what is happening to the smaller, less efficient miners? They are getting crushed. Their margins are evaporating. Some of them are already curtailing production. And every ounce of curtailed production deepens the deficit. But here is the signal that matters most from that earnings report. Despite rising costs, First Majestic doubled its dividend policy to 2% of revenue. Why would a mining company double its dividend when costs are rising? Because they are confident the silver price will stay elevated. They are telling you through their capital allocation decisions that they believe $80 plus silver is the new baseline. No. TA spike. Not a temporary anomaly. The new normal. When the people who actually dig silver out of the ground are so confident in sustained high prices that they commit to higher shareholder returns, that tells you something the price chart alone cannot. Now let me bring this all together because I want you to see how these pieces connect into a single coherent picture. You have Nvidia creating a new category of silver demand that did not exist 2 years ago. 800-volt data centers and the solar farms that power them. This demand is inelastic, accelerating, and backed by hundreds of billions of dollars in committed capital expenditure. You have a 6th consecutive year of structural supply deficit with no meaningful supply response possible for 5 to 10 years due to mining economics and byproduct dependency. You have above-ground stockpiles being drawn down by 67 million ounces per year, shrinking the buffer that has prevented a delivery crisis. You have mining costs rising 25% year over year, creating a structural price floor that gets higher every year. You have the Shanghai Futures Exchange purging speculative positions by February 28th, which will create short-term volatility but leave a cleaner market driven by physical fundamentals afterward. You have a technical chart that just broke a multi-week downtrend, recaptured both major moving averages, and is pointing toward 92 and then 100 plus. You have the world's largest silver-consuming nation, China, paying physical premiums that are $9 to $15 above the Western paper price, proving that the real clearing price for metal is higher than what COMEX shows. And you have central banks and sovereign nations quietly adding silver to reserve strategies and collateral frameworks, signaling that the remonetization of silver is not a conspiracy theory. It is a policy shift happening in real time. Each of those factors alone would be significant. Together, they form what I believe is the most compelling convergence of bullish catalysts in silver market history. Stronger than 2011, stronger than 2021. Because this time, the demand is not coming from Reddit and coin dealers. It is coming from Nvidia and China and sovereign balance sheets and the hard physics of thermal conductivity at 800 volts. So what do you do with this information? I am going to tell you what I am watching, and you can make your own decisions. I am watching $82 as support. If it holds, the bull case is intact. I am watching 86.34 as the breakout confirmation level. If silver closes above it on a 4-hour candle, the next target is 92.31. I am watching February 28th as the volatility catalyst. I expect choppy price action between now and then as SHFE positions unwind. I am watching COMEX registered inventory for any sign of accelerated drawdown. And I am watching physical premiums in Shanghai for confirmation that the real price is still above the paper price. If you own physical silver, this analysis should give you confidence. You own the actual metal. You are not dependent on a counterparty. You are not exposed to margin calls or forced liquidation. The short-term volatility between now and February 28th is noise. The structural deficit, the AI demand, the mining cost floor, those are signal. And the signal says you are positioned correctly. If you are trading with leverage, the next 5 days are dangerous. The SHFE deadline could create violent swings in both directions. A $2 or $3 dip that lasts 12 hours can wipe out a leverage position even if the price is $20 higher a month later. Consider reducing your position size, widen your stops, or step aside entirely until the February 28th deadline passes and the dust settles. There is no shame in protecting your capital. There is only shame in knowing the risk and ignoring it because you were too greedy to be patient. If you are in cash waiting for an entry, the question you have to ask yourself is whether the dip you are waiting for is going to come. It might. The SHFE liquidation could push silver to 80 or 78 briefly. If it does, that could be your entry. But what if it does not come? What if Friday's breakout was the launch and silver grinds to 88, 90, 92 from here without looking back? The cost of waiting for a perfect entry is sometimes missing the entire move. Markets in structural deficit with inelastic demand do not give you comfortable entries. They give you uncomfortable decisions. You either accept a price that feels high and get positioned, or you wait for a pullback that may never arrive and watch from the sidelines as the deficit math plays out exactly as the numbers said it would. I am not telling you what to do. I am showing you the mechanics, the data, the catalyst, and the timeline. What you do with it is your choice. But understand this. Silver is no longer the metal it was 5 years ago. It is no longer just a monetary hedge or a speculative plaything. It is the metal that makes the AI revolution physically possible. It is the metal that makes the energy transition function. It is the metal that 6 years of deficits have systematically drained from global inventories. And it is the metal that multiple sovereign nations are quietly reclassifying from commodity to strategic reserve. That is not a trade. That is a structural repricing. And structural repricings do not care about your comfort level. They do not wait for you to feel ready. They happen when the math forces them to happen. And the math is forcing this one right now. February 28th is 5 days away. The SHFE deadline will clear the speculative noise. After that, the market will be driven by physical fundamentals, institutional positioning, and the relentless arithmetic of 800 million ounces of supply facing 1.3 billion ounces of demand. Subscribe to this channel right now. Turn on notifications, because I will be here every single day this week breaking down the price action, monitoring the SHFE liquidation, tracking COMEX inventory, and showing you in real time whether the breakout holds or fails. This is the week that sets the trajectory for silver for the rest of 2026. Do not miss it. Drop a comment below. Where in the world are you watching from? Do you think silver holds 82 this week, or does the SHFE deadline create one more dip? And do you believe the Nvidia demand story is the real catalyst, or is it being overhyped? I read every single comment. I want to hear your perspective, because this community, this global community of people who understand what silver actually is the reason this channel exists. That 8% move on Friday was not the end of something. It was the beginning. And the beginning of a structural repricing in the most important industrial and monetary metal on Earth is not something you want to experience from the wrong side. Like this video, if it opened your eyes to something you had not considered, share it with someone who still thinks silver is just a shiny rock that conspiracy theorists hoard. And I will see you tomorrow with the Monday Open Breakdown. This is Mr. AG Asian Guy. The clock is ticking. February 28th is coming, and when the dust settles, the only thing that will matter is whether you owned the metal or you owned the paper. I will see you in the next one.